Directors approved Basin Electric and Dakota Coal's risk tolerance for 2018 to 2022 at the February meeting. Dakota Gas's was approved in December. Kerry Kaseman is manager of commodity risk for Basin Electric and reports to the board each month on behalf of the Risk Management Steering Committee. He explains the process for how Basin Electric, Dakota Gas, and Dakota Coal's risk tolerance is determined each year.
The process starts in early part of the year with the kickoff of the financial forecast in March. And it starts with middle office. They develop a pricing scenarios, a base pricing scenario, a high pricing scenario, and a low pricing scenario for all of the commodities that Basin, DGC, and Dakota Coal utilize. At that point, it goes to the pricing scenarios go to Cooperative Planning for review or for input into their model, where they develop for Basin expectations for purchase power, surplus sales, and so forth. And then for Dakota Coal Gas Company for the various products they deal with, natural gas, tar oil. Once the modeling is done, it goes to Dakota Coal Company, where they take the Basin products, put it through their modeling to develop the coal price. Once that's completed, it goes to financial planning to kind of bring it all together. That's where they develop then the expectations for the impact of these high, low, and base pricing on net income before tax. And from that, then primarily middle office comes up with a recommendation for the risk tolerance, which then goes to a Risk Management Steering Committee working group for review, and a final recommendation is developed. At that point, it goes to the Risk Management Steering Committee for review and approval, and then finally to the Board of Directors.
Kaseman says it's through those groups that determine the level of risk Basin Electric and subsidiaries are willing to tolerate, as directed by the Board of Directors.
So it really boils down to something fairly simple. For example, say you're going on a vacation, you've got 10 family members, and your airfare is currently at $1,000. And you look back and you see that prices could go down to $500 a ticket. So for your family, you'd spend $5,000, or it could go up to $1,500 a ticket, and for your family, you'd spend $15,000. So you've got a range now of $5,000 to $15,000. And so now you want to make a decision: how much of that risk do I want to take off the table? How much do I want to leave? So, our recommendation to the board would be, we want to take half the risk off the table. So we want to spend $5,000 now, and if prices go down to $500, then we end up spending another $2,500. So we narrow our range from $7,500 to $12,500 by buying half the tickets now and waiting. So that's really what the risk mitigation is narrowing that range of possibilities. So now imagine you're going on vacation and you're planning a vacation for 5 years. You might decide to buy half your tickets now for next year, 40% for the next year, 30% for the next year, 10% for the following years. You're just taking a little bit of the risk in the outer years off. And so that's kind of what we did with the risk tolerance is, we're recommending more risk off the table now and less off the risk in 2022.
For Basin Electric, the products considered are power purchase agreements, surplus sales, and natural gas to run the peaking power plants. At Dakota Gas, the products are natural gas, tar oil, electricity, urea, naphtha, phenol, and crylic acid. And at Dakota Coal, it's diesel fuel. The next step after the risk tolerance is approved is that marketing and asset management develop a hedge plan, which will be brought to the board in April.